September 29th, 2008, the single worst day in the history of the Dow Jones. Responding to actions by the Congress to reject a relief program, the stock index, which represents the health of the New York Stock Exchange, dropped a total of 778 points and lost $1.2 trillion. But to financial experts, this drop and the corresponding crashes over the next month were no big surprise. The housing market had been in turmoil since early 2007, when the mortgage giant Freddie Mac announced they would no longer buy risky subprime loans. For some keen investors, early indicators of the impending crisis were obvious even years before that. The 2008 recession was the result of the burst of the United States housing bubble. An economic bubble is a natural phenomenon when an asset's price strongly deviates from its intrinsic value. This results in a phase of rapid growth called a boom, followed by a phase of rapid decline called a bust.
Take, for example, the dot-com bubble. In 1997, with the success of internet and internet companies, many investors saw great potential in new websites such as Pets.com and eBay and decided to buy their stock. As more people bought the stock, the company did better, and this created a positive feedback loop that raised the prices of their stocks even more. Soon, the stocks were selling for much more than they were actually worth. This was the boom phase. When the investors realized that the prices had gotten too high, they stopped investing and instead sold their stocks, resulting in a panic that created a negative feedback loop, causing more and more people to sell and eventually crashing the stock. This is the bust phase.
A similar situation happened in the real estate market during 2008. But before we go into exactly what happened, let's first go over a few terms. A security is a tradable financial asset. A mortgage is when the bank loans you money in exchange for ownership of your house. When your loan is paid back to the bank gives your home back to you. Combining the two, you get the mortgage-backed security, which essentially allows the bank to view your mortgage as an asset, which, if it chooses, can sell or trade. Stemming from this, financial institutions also created something called a collateralized debt obligation, where the underlying asset can be any kind of debt, including bonds, mortgages, and other asset-backed securities. These MBS and CDOs can be composed of only one asset or a collection of assets. All loans have a credit rating. Three big companies, S&P, Moody's, and Fitch, review the collections and assign each a credit rating ranging from AAA, the best, to D, the worst. Subprime loans are mortgages that have a credit rating of BBB or worse. Investors usually are hesitant to buy subprime loans because of the risk associated with low credit ratings. The problem in 2008 occurred when financial institutions bundled together hundreds of mortgages with credit ratings from all over the spectrum into a single MBS or CDO. Because of the size of these bundled securities, the collection is automatically given a rating of AAA. This is based on the idea that if a single mortgage fails, then the others will be strong enough to make up for the losses overall. However, over time, these collections became riskier and riskier, with some composed of over 80% subprime loans. Despite this, credit agencies were encouraged by the boom of the great housing market to continue to rate the collections as AAA.
Now imagine this. This Jenga set resembles a collection. The collection is made up of securities of all credit ratings, but is built on subprime loans. Imagine the top blocks are made of strong loans like AAA, AA, and A, but the bottom ones are made up of subprime loans like BBB to D. Because of its size, this collection has an overall rating of AAA. Now, if a single subprime loan was to fail, nothing would happen. But if multiple failed, then this collection would become very unstable and eventually crash.
As borrowers who had been approved for a mortgage under this system began to foreclose and fail to meet the payments, the collections began to fail. Investors soon realized that the MBS and CDOs were unstable and refused to buy more. And when they saw the signs of the impending crash, they started to sell their mortgages as fast as possible, creating a panic. This brought the market into the bust phase, which lasted for nearly a year from late 2007 to late 2008. While subprime loans, CDOs, MBS, and inaccurate credit ratings were not the sole cause of the 2008 recession or even the housing bubble bust, it was one of the most substantial factors.
After 2008, this was the average person's home. The end.